This week, our experts are talking about interesting opportunities in auto parts, consumer finance, and share buybacks. And Todd, we start with you. Start at the beginning of the alphabet, auto parts.
Yeah, auto parts. Standard Motor Products is the company. SMP is the ticker symbol. The company manufactures replacement parts for motor vehicles in the aftermarket industry. And they have been increasing their focus on original equipment manufacturers, but they're still primarily aftermarket replacement parts company focused on two segments. One is engine management, and the second is temperature control solutions. Company just came off a big first quarter earnings beat in early May. They had solid revenue growth, but the big story here is the expanding gross profit margin. The company's been increasing in-house production and increasing production in their low-cost manufacturing plants in both Mexico and Poland. So that's driving big bottom line growth, and it prompted analysts to revise their estimates significantly higher for both 2013 and 2014, and that sent it to a Zacks rank of 1, which is a strong buy rating. So very solid earnings momentum here, and if you look at consensus estimates, analysts expect a solid double-digit earnings per share growth over the next couple of years, but their stock's only trading about 14 times forward earnings. That's a discount to the industry average, so there's a lot to like here. There could be strong total return potential in this name.
All right. Brian, a lot to like in your pick, consumer finance?
Yeah, Discover Financial Services. So it's the credit card company, and I think all of us here have a credit card.
No.
Yes.
No? Okay, no? Well, or not. So let's just use PayPal for everything. But Discover is uniquely positioned. It's the smallest of the big credit card companies. It is a $23 billion company. But I think the idea here is that the valuation is really nice. I think you have a 10 times forward and trailing PE, and that is lower than the industry average for its group. But the more conservative measures like price to book, price to sales are showing them trading at a slight premium. The thing that I took away from looking at this company, obviously you've seen earnings estimates move higher throughout time, or at least throughout 2013. And into 2014, and the stock is up 23% this year. And as you continue to see, job growth, things like that, you're going to see more consumer discretionary spending, and that's something that the credit cards really like. The net margin for Discover is 25%, and when you compare that to 15% for the industry average, you see that they are keeping more of the money that they bring in. But the problem is that next year they're looking at 25% negative top line growth. So
wow.
A little bit of a struggle up on top, but as we get more jobs, that might solve itself.
Okay, no little ditty that you've prepared about credit cards?
No.
Okay. I just double checked.
Keep charging.
Nina, talk to us about share buybacks.
Yes, it's PowerShares Buyback Achievers ETF. The ticker is PKW. Now, dividend ETFs are very popular with investors, and they have been hot this year. And I still like dividend ETFs, but the outlook for high yield dividend ETFs doesn't look so good as of now. I still like dividend growth ETFs. But at the same time, investors largely ignore that companies also return cash to investors by way of share repurchase or buybacks. Mm-hmm. And they have been changing their payout mix more towards buybacks. That has been happening in the last couple of years, and this first quarter of this year too. There were more buybacks than dividend payments. This particular ETF focuses on companies which have bought back at least 5% of their outstanding stock in the last 12 months. This is surprisingly not as popular as dividend ETFs, but it has been outperforming broader markets over the past 5 years. And this year too, it has returned 20% versus 15% for S&P 500. In the last 5 years, it has returned 67% versus 37% for S&P 500. It currently focuses mostly on consumer discretionary, financials, and IT sectors, which look good as of now. Charges an expense ratio of 71 basis points.
Okay, thank you for that. Don't forget, if you're watching this video in syndication, that you can always go to Zacks.com and right from the homepage, link to other stock picks and stock picking strategies that you might find interesting. With everyone here, I'm Terry Ruffalo.